Okay, hi everybody. Welcome to BUAD 293 Entrepreneurship via video lecture rather than our online class. I'm not quite sure what's happened there, guys. For some reason, the class was setting up exactly correctly for me, and so I was into the class there waiting for everybody, but no one else could get into the class. So I'm going to need to go back to IT, check on that, see what the problem is, and hopefully we can have that fixed by Wednesday. However, in the meantime, guys, what we can do is I'm going to obviously record the class, give you guys all the information via this way, and then you guys can go back and watch it and do any activities that we need to do based on that. So today's class, guys, was going to be about financial analysis. So going back, looking at the financial documents that we needed to get in place. There were a couple of things that I wanted to do, but I'll split them up into different videos. I wanted to go over our overall report directions. So the business plan report, I'd like to do that, but I'll send that out in a separate video. I want to have a look at the financial analysis. And then the last part is I was going to give us time to work on our financial documents, which is actually part of our business report. So I'll explain all that as we go, but let's just get into the financial analysis here, guys. Just looking here at our schedule, obviously we're March 9th here, so financial analysis, that's chapter 11. In the next class, we'll look at financing your business, so where to actually get investment from. So basically, we're in this one, we're looking at our financial documents to see if there are any metrics or any ratios or any margins that we need to be looking at that's going to tell us how our company is doing. So this is pretty important, guys, because when we come to pitching our information to investors, they're going to take some of these financial ratios, these analysis metrics, and they are going to apply them to our companies, and that's going to tell them whether or not this is a good thing to invest in or not. So those metrics can be things that we need to follow, we need to watch, and we need to optimize if we're not quite doing them as well as we could. So essentially, guys, it's a form of financial analysis. So what do we think are the best criteria to judge a company's financial success? What areas, well, let's think of maybe 4 areas that we could use to judge a business's success. So we can pause there, guys, if you want to think about that for a second. Otherwise, we're going to go straight into spoilers. First one, guys, is your debt repayment. So this is important, guys, because if you are a company that's got a lot of debt, lots of loans, obviously, if you can't keep up with that payment, the company is going to collapse. So do we have the capacity or the liquidity, the ability to get liquid cash, essentially, quickly to repay any debts? So that could be on a short-term basis. That's what we talk about when we talk about the current ratio. We'll talk about that in a second, guys. Or it could be on a long-term debt repayment schedule as well. So can we pay back our debt? If we've got loans, if we've got investment, can we pay that back? How profitable, another one here, are our assets? So when we think about the assets that we have, our fixed or current assets, inventory, vehicles, buildings, all of these different things, how much money are we making on those? Are we actually getting good value out of them, and are they leading to better profits for us? So basically, our asset profitability is a big one. When we're looking at this, guys, some companies can buy lots of assets and then not use them, not get any decent return on them. If you want an easy example of that, think about machinery. So, for my companies, when we were producing T-shirts, we had DTG, direct-to-garment printers. So how many finished products were those printers putting out per hour, for example? That would be a KPI that we might follow. And then basically, we're paying money to repay the payments on that piece of machinery. Is it doing enough production that it is covering its cost and then actually creating some profit. So what is the profitability on that asset? The next one is our debt usage. So when we're obviously increasing our debt, guys, we're increasing our risk. But that should be going into the company in productive and efficient ways. So that should actually be increasing the expected rate of return on equity. So are we able to actually pay off more or give out more dividends? Are we actually, as owners, making money from the company? When we think about investors there, obviously they're going to want to see their money that they're loaning to people or investing in the company make money and start to make them money back, right? So are the funds that we're putting into the company increasing the profit and therefore increasing what gets returned to people with an equity stake? And then last one here, guys, rate of return. So, how quickly are we able to get money back? How quickly are we able to get dividends? That's obviously going to affect how people look at a company and whether they want to put money into it. Okay, guys, we mentioned in the last class just about having good advisors, having good people who are there to support you. This definitely includes a bookkeeper or an accountant, someone who can keep a track of all of the cash inflows and cash outflows from your company. This might refer to our first one there, guys, AR, accounts receivable. So basically any money that we have owed to us. So our AR, anything coming in, so keeping a track of that. Now, when you think about companies that have lots of sales happening month to month, maybe a company takes an order in 1 month and then pays for it in the following month. Maybe there's terms on how long it takes to pay. Keeping a track of all of that can be difficult. So having somebody who's able to keep up with your AR is important. On the same way, guys, AP, your accounts payable, is also important because we, as a part of a supply chain, will also be purchasing things from different companies. So we've got to keep a track of all the money going out as well. Keeping a track of our inventory, really, really important, guys, depending on what type of company you have, of course. Service companies probably not going to have as much inventory, but in terms of keeping a track of how often we're purchasing inventory, how often we're stocking up, how quickly we need to get it, when we're paying for it, there's lots of different things that we need to think about when we're thinking about our inventory. Payroll, a big one, guys. Obviously, if we've got lots of employees in our company, if we have any employees in our company, we're going to need to keep a track of payroll so that we're able to make the payroll deductions and all of the taxes that are involved in that. Of course, guys, if we've got goods and services or all of the other things here, the harmonious taxes, we're going to need to make sure that we're up to date with all of our tax. We don't want a big tax bill from the CRA. That would be bad. Cash as well. If we've got petty cash or if we've got cash register, make sure that we are keeping eyes on that. That's an easy place for employee theft to happen. So need to keep a good eye on that. Our fixed assets, basically all of our assets, guys, are fixed or current. Any type of depreciation for those assets as well, we'll need to make sure we're keeping an eye on that. And then anything else, insurance, leaseholds, investments, any other types of money coming in or out, we need to keep an eye on that as well. Okay, let's just get into our metrics, guys. This class is not going to be a super long class. We'll just go over a few of these things. But here we have 10 important metrics that we can look at to see where our company is at. I mentioned before, guys, the current ratio. That's one of the big ones that we look at when we want to know if a company will survive in the short term. Our debt ratio might be over a longer term. But let's have a look at all of these, guys. And we can see here, these ones in the orange, we can find these from the income statement. These ones in the blue, we can find from the balance sheet. In the green here, we can find them by looking at both the income statement and the balance sheet. So again, guys, I will post these slides into Moodle so you can go back and have a look. But here we have a table that shows a number of different things. So what the metric is, or the ratio, what the formula is to calculate that, what it actually shows, and what a healthy margin or ratio might be in that area. So, I mean, when we're looking at income statement, guys, we've got the gross profit, the operating profit, and the net profit margin. We actually talked about that a little bit in the last class, but these are all margins that are handy to look at just basically to see how we're doing in these areas, right? Gross profit is going to show us our how well we're doing with our sales, how well we're doing with actually generating revenue, right? So that's our sales before we deduct anything or all of our revenues coming in. So how well are we actually doing just from a sales perspective? And if we look there, 50 to 70% plus is doing well. When we get to our operating profit margin, guys, this is when we're minusing the operating costs. So this is actually telling us how well we're doing from an operating perspective. So how efficient are we in our company in terms of our operations, our things like manufacturing, our day-to-day workings. How efficient are we there, and how well are we actually doing to reduce those costs so that our profit increases? If we're 15% plus there, guys, that is going to be pretty healthy. Then we've got our net profit margin. So this is if we're generating enough profit from sales and if costs are under control. So basically, when we take off things like investments and tax, are we actually generating enough profit? We can see that's dropped down to 7 to 10%, but that's basically once we've paid everything, we've paid out all of the different areas. If we're up around 7 to 10% pure profit, then we're doing okay. From our balance sheet, guys, we've got a couple of different ratios that we can look at. Debt to equity. So what's our total debt divided by our total equity? So this is going to tell us how much we owe to the bank and how much we owe to our investors. So there's a couple of things there, guys, that we need to think about. Remember, if it's to the bank, if we owe money to the bank, their repayment schedules, their structures, everything there is going to be really, really strict. So if we've got a high debt on the loan side, that's going to mean that we have to be very, very restrictive or very, very careful with our repayments. When it comes to shareholders, they may be a little bit more inclined to sort of make some deals, give you a bit of leeway in terms of your repayments. So that debt to equity ratio can tell us how rigidly we have to pay back our debts versus how much leeway we might have there. So if it's around 1.5, that's going to be a healthy debt to equity ratio. Next one is our long-term debt to asset ratio. So our total long-term debt divided by our total assets. We talked about the ability to pay off things in the short term, but this is going to tell us in the long term. Do we actually have assets? Do we have the money to be able to survive in the long term, right? So long-term debt to asset ratio, that's going to show us in the long term. Our next one there, number 6, is our current ratio. So that's going to show us based on our current assets, things like cash in hand versus our current liabilities, how well we're able to do within a year's time. Okay, so if that's in the negatives or if that's under 1 there, we're starting to get bills piling up. That tells us we're not something's going wrong with our operations or something's going wrong with our sales, that we're not actually able to pay these ones back. And that's going to create legal issues. It's going to create liability. So that's what we want to avoid. Our debt ratio is basically the total of both divided by total assets. So basically, how much of our assets is financed by debt? We want to bring that down to 35%, less than 35%. So basically, we have paid off our assets, and they're actually just creating clear profit rather than still, paying for them. Now we get into things that are both on the income statement and both on the balance sheet. So return on assets ratio. So our operating profits divided by our total assets. So this is really comes down to efficiency. How much money are we actually making out of these assets based on our operations? And 5 to 20% plus is going to be pretty good there. Total assets turnover. So how efficiently a firm is using the assets to generate sales. Again, guys, the return on assets ratio, number 8 there, is more to do with the operations, where total assets is basically what we're doing as a whole. So how well our assets are actually contributing to our overall sales. And then the last one here, guys, this is important for investors, is a return on equity ratio. So the net profit that we're making divided by the owner's equity. So basically how effectively we're using that investor's money. Yes, are we growing the company's value at an acceptable rate? Basically, are investors happy with how much their share value is going up? And if we can see 15 to 20% there, that is healthy. So, guys, these are some of the things that we want to look at. There's a lot of other ratios, but these are the 10 most important ones that kind of tell us where our company is sitting in general. Guys, you'll see the in-class activity for today is to have a think about your company and have a think about which of these metrics they would do well in. So, your company might have very low debt. Maybe you've got, your owners, the people who are going to be your investors or shareholders, which could be yourselves. Maybe you have money to put into it. So maybe your debt's going to be low. So your debt ratio might be also low. Maybe it's a service company, so you don't have as many assets. So that means your current ratio is going to be really, really good as well. Right? So think about your company specifically, the operations of your company. Which of these are going to show good results? Because then you can highlight those as part of your package to investors. Okay. A couple of examples here, guys. Current ratio 1 to 1.2. We mentioned that already. A high ratio indicates poor asset efficiency. So we're not actually using our assets well to pay back our debts. Return on assets, 5%. Over 20% is excellent. We've already seen these here, guys. Operating profit margin of 5% and 20% is excellent. Total assets turnover of 2.5 or more is considered healthy. Debt ratio under 30%. And we see here, guys, here a note, over 40% could make creditors reject you. And 15 to 20% here for return on equity. Yeah, there we go. Okay, just quickly, guys, we've got a couple more things to look at here. We won't take too long in this because we're already at 20 minutes here. But profit margins by industry, guys, we want to think about what industry we are in and whether or not there's going to be a high profit margin that we can promote to investors. So a couple of different industries we've got here, guys. So we can see finance, software, transportation, tobacco. obviously being an inelastic product. Software, computers and peripherals, information services. Just thinking about our companies, we have a finance company, so that's got a high profit margin. We have a software company, so that's going to be around the 20% mark. And again here, guys, when we've got services rather than physical products, cost of goods will be lower and profit margins will be higher. That's just something to think about when you're thinking about what type of ideas make sense and what are the most viable. And here, guys, here's an overall look at different industries. When we're thinking about some, we've got a couple of teams, our round trip and our print again, maybe in the not apparel, household products, I think there. So there's 50% gross profit margin there. So you guys need to be looking at that and thinking, are you reaching these benchmarks here? So look at your industry here, guys. Look at the average profit margins and see where you guys are going to be sitting as well. Okay, these are just a couple of examples, guys. You can look at these and you can go in and do some analysis on those. But otherwise, that's all I wanted to cover in terms of content for today. I will be doing another video to go over the assignment. And then the other part was filling in the financial documents template. So I'll do another video to go over that as well. All right, guys, hopefully I'll have all the problems fixed by Wednesday, and we'll be back in class for that. We'll see you then.